It's 9 o'clock, and so we're going to try to stay on time because we have a lot to accomplish today. I'd like to call the Workers' Compensation Insurance Committee to order. We don't need to take a roll call. We'll mark everyone's attendance. I'm Ohio Senator Bob Hackett, and I'll be chairing this meeting today. I need a motion to waive the quorum. Yes, so that in a second. All in favor, please say aye. Aye. Opposed, nay. Next thing we need a motion to approve the March 10, 2023 minutes. Can I have a motion? You have a motion from there? Second. From Steve. All in favor, please say aye. Opposed, nay. Okay, we'll start today with a state-of-the-line presentation from Jeff Ettinger of the National Council of Compensation Insurance. Now, as a reminder, Jeff's presentation, along with everybody else's, are on the website and on the app as well. So, Jeff, it's all yours. Thank you.
All right. How's that?
Yeah, we can hear you.
All right. Okay, good. Yeah, I'm going to give a pretty quick overview of the workers' compensation system. So this is the first time really that we can see data pre-pandemic and post-pandemic. So certainly the pandemic had some impacts on the workers' compensation line, but when we start looking at the results, you could see that it really did not have any bad impacts on what was already a stable and well-performing system. So the combined ratio, the calendar year combined ratio, which compares losses and expenses to premiums, came in 2022 at an 84, which is a 3-point improvement over 2021. This was the 6th year in a row where the calendar year combined ratio was below 90%, and the 9th year in a row that the calendar year combined ratio was below 100%. So obviously, this line of insurance has seen very consistent, very good results, and that has not changed due to the pandemic. The 3-point improvement was basically in the loss ratio, so the other components of the combined ratio have remained fairly stable. So that's a 16% underwriting profit for the latest year. Then when you look at the investment gain on insurance transactions for 2022, it is down a couple points from 11% the previous year to 9%. Slightly below the long-term average of about 12%. But when you combine the underwriting profit with the gain on investments, you're looking at a 25% pre-tax operating gain, well above the long-term average and even above last year. So when we look at the premium, then we will see the impact of the pandemic. So you can see there from 2019 to 2022, the dip in workers' comp net written premium. And then the latest year is up 11% from the previous year to $47.5 billion, pretty much returning to the pre-pandemic levels. So even though that's a large increase for 1 year, really when you look at it from 2019 to 2022, it's a fairly small increase, about 3%. So we're going to kind of dig into that a little bit as to what is behind that. So from 2021 to 2022, that large increase is really being driven by a 10% increase in payroll. And that's pretty much evenly split between increases in the levels of employment and increases in the wages. So then if we look over the pandemic period from 2019 to 2022, as I said, it's a much smaller increase. Although during that time, payrolls did increase more than 20%, driven almost entirely by a 20% increase in wages. However, what's also happened during the last several years was NCCI has been filing pretty consistent loss cost decreases in the states that we handle. So this shows the latest round of filings, with the largest decrease being almost 17% decrease in DC, and there was only one state that showed an increase. So we've seen a pretty consistent drop in the Bureau premium levels over the last decade. Just for the last year alone, it was almost a decrease of 8%. So over this pandemic period, while payrolls have been up more than 20%, the loss costs have been down 20%, pretty much offsetting that. That's why it's only a slight decrease. And then looking at the other premium levels in the residual market, they've remained pretty consistent, but they've also dropped in the residual market, both because we've been decreasing the rates in the residual market and also because the line is very competitive. Companies are willing to write business voluntarily, so the residual market is the smallest that it's been in recent years, with a residual market share of about 6%. The pandemic period also saw some fluctuations in some of the loss drivers. So we were seeing pretty consistent improvements in claim frequency prior to the pandemic. And then the year the pandemic hit, 2020, we saw a pretty large drop in frequency of 8%. And then the following year, we saw an increase of 8%. And then for 2022, after the pandemic, we're back to the average historical improvement of 4%. So during that whole pandemic period, we're looking at a decrease of 5% in claim frequency. Claim severity, or the average cost per claim for both indemnity and medical over the last few years, has been pretty moderate. So, when we talk about why for workers' compensation can we see year after year of loss cost decreases, remember that the exposure base is payroll. So payrolls go up, premiums are going to go up automatically. And if the losses don't go up as much as the premium, we need to decrease the loss costs. And so when we're in an environment where workplaces are getting safer, there's fewer accidents, there's fewer benefits being paid out. Now, sometimes the amount of benefits could go up, but we have not seen that in recent years. So for wage replacement, for indemnity, we did see a 6% increase in the latest year. But over the pandemic period, it's been about a 2% increase per year in the average indemnity claim. So when you consider that indemnity benefits, pretty much you'd expect them to be in line with wages. Just waiting for this slide to build. Okay. Nope. Go back. You would expect indemnity benefits to be in line with wages, but that has not been the case. So over this long time period, when wages have grown 90%, indemnity claim severity has only grown 57%. So it's lagged, it's been below the actual wage inflation. So again, payrolls are going to go up when wages go up. If indemnity benefits don't go up as fast, loss costs need to decrease. A similar story for medical payments. Even though it's up 5% in the latest year, over the pandemic period, it's been about an annual average increase of only 1%. Now, you'd expect medical benefits to go up, maybe with wages, but also with kind of a medical CPI. but similar to indemnity payments, we have not seen the medical payments keep pace with how we would measure a medical CPI. A bit closer, the changes for medical than indemnity, but still below what you might see. So again, with severities not even keeping pace with wages and with claim frequency dropping, this is why we're in an environment where we've seen decreases, and many cases double-digit decreases in the loss cost levels for our states. So now that we're through the pandemic, we can look back on just the impact of COVID claims in particular. So for NCCI states, we did see over 100,000 COVID claims, resulting in more than $600 million paid out in losses. They're pretty much small claims, about $5,000 on average, and they really represented only 1% of total losses. This just shows how those amounts break out by year. So obviously 2020 was the largest. 2021 started to taper off, and there's been really a huge drop in the number of COVID claims from 2021 to 2022. So doesn't mean there's zero, but they're at an extremely low level. So these are kind of the big highlights. That premium increase of 11% kind of gets that premium amount back to the pre-pandemic levels. Combined ratio of 84% for the calendar year, and even for the accident year, the 97 is below 100. I didn't really touch on it, but there's also the largest reserve redundancy we've seen probably in history. So there are carriers are sitting on a lot of extra reserves at this point. Claim frequency has decreased back to normal levels of about 4% a year, and indemnity and medical severity are up for the latest year, but still fairly moderate. So with that, I'll take any questions.
Thank you. And I'll just open it up to the legislators for questions. Any questions from anybody? Looks like I think we're good. Jeff, thanks. It's always a valuable presentation, and we look forward to seeing it each summer. If you have any questions, you can reach out to Jeff if you'd like to discuss anything. So next on our agenda is a presentation on trends in states after the adoption of drug formularies. With us today is Ramona Tanabe, CEO of the Workers' Comp Research Institute. As a reminder, NCOIL adopted a Workers' Compensation Drug Formulary Model Act in 2019. That model can be viewed in binders on page 171 and on the website. Today's presentation will provide good information for this committee to consider before we go through the model for readoption at the 5-year period. So Ramona, thanks for joining us today, and it's all yours. Thank you.
Thank you very much, and thank you for inviting me to speak today. WCRI, if you're not familiar with us, we are a independent nonprofit research organization, and our mission is to be a catalyst for significant improvement in workers' compensation by providing credible, high-quality, independent research so that when there's a policy debate, it's an informed policy debate with data. So that said, today I'm going to talk about some of the states that have adopted drug formularies and what we see of the effect. I know there's a model act that was adopted by NCOIL in 2019. There hasn't been a state that adopted a drug formulary since then, but before that, 17 states have adopted drug formularies for injured workers. Today we're going to talk about California and New York specifically. A drug formulary is essentially an approved drug list, and drugs that are not on the list require pre-authorization or before they can be dispensed or prescribed. So 17 states have adopted drug formularies, and they all have different features to them, so you can't quite do a comparison of one to another because they all have different requirements for pre-authorization. Many had different phase-in periods, and some states wrote their own drug formularies. So the states that are in dark blue are the ones that have adopted drug formularies as of the beginning of this year. And 10 of the 17 are based on either ODG or ACOM guidelines. California, that we're going to talk about today, has a state-specific that works in conjunction with the ACOM guidelines. And the purpose for California was to define reasonable and necessary pharmaceutical treatment for injured workers. So when we think about drug formularies after the implementation, there are a number of questions that we ask. Did it reduce the utilization of prescriptions? What was the impact on drugs that were either on the formulary or not on the formulary after the implementation date? And what about the different types of drug groups? Did it hit everything differently? And also physician dispensing. I know there's another model act, I think it's referred to as repackaging within the NCOIL model act there. What's the effect on physician dispensing and generic use within the formulary? And most importantly, or sometimes least importantly, did it reduce payments for the spend on prescription drugs? So this is a summary of the effect of pre and post formulary for California, New York, and answering those questions. And you can see in the left-hand column for each of those for California, New York, the numbers are all negative. They're compared to the group of states that don't have a formulary in place, and because there might be externalities that also affect what's happening within the payments for prescriptions. So the reason those non-formulary columns are not the same is because they're two different periods. They adopted them at different points in time, and the pre-period and the post-period are different time frames. So you can see they're pretty significant effects, and we'll go through each one of these in detail. So first, California. California was adopted in January 1st of 2018, and you can see California in the blue line there. This is looking at the number of prescriptions per medical claim, and the yellow line there shows the non-formulary states. So there was a significant decrease in California. What this doesn't show is the effect of claims, what percentage of claims actually receive prescriptions. So when we look at that, you can see on the left-hand side the percentage of medical claims that receive prescriptions. California looks more similar to non-formulary states after the decrease in 2018. And then on the right-hand side, the number of prescription claims, the number of prescriptions per claim, when you have one, how many did you get? So it also decreased the effect of requiring pre-authorization for certain types of drugs. The proportion of prescriptions and prescription payments in California before the adoption of the formulary was about half of the prescriptions that were issued in California before it was adopted. So they call them non-exempt and exempt drugs. Exempt from the formulary are ones where you don't require pre-authorization, but non-exempt and unlisted drugs require pre-authorization. And so when we look at what happened to those different groups of exempt drugs, non-exempt drugs, and unlisted drugs, you can see that the non-exempt drugs had a large decrease in that time period. So we're looking at the number of prescriptions per claim that had a prescription. And the exempt drugs, the ones that didn't require pre-authorization, were pretty static over the time, a very slight increase over time. And unlisted drugs were were infrequently prescribed, so that one stayed pretty stable as well. This is just a different view to look at how did California compare to those non-formulary states for those other measures. And for those non-exempt drugs, there was a small decrease in non-formulary states, but not to the extent of California. So the effect of the formulary was significant. The physician dispensing in California also had a large decrease compared to the non-formulary states. The physician dispensing was also a piece of the formulary that they had requiring pre-authorization. So hand in hand, they work together. Don't see any change in that in the non-formulary states. Or I'm sorry, the pharmacy dispense prescriptions are the ones in yellow. So those didn't increase or decrease. They were essentially the same. And this is compared to other states, what was happening in terms of physician dispensing and pharmacy dispensing. So California had a much larger decrease than states that didn't have any regulations affecting drug formularies. The other thing we wanted to look at was what types of drugs were mostly affected. And you can see the largest one there was the 50% decrease for the muscle relaxants, musculoskeletal therapy agents. And those include things like lidocaine. Nope, that's not right. Include things like Flexeril. And the dermatologic agents are the gels and patches. Those didn't decrease as much, but they did decrease. The next largest one was opioids, but also at the same time, you can see in the non-formulary states, there was an 11% decrease in opioids. There was a lot of attention paid to opioids during this time period, so some of it were external to the drug formularies that were in effect at the time. So in summary, California's adoption of the drug formulary was large and immediate. You could see an effect in the quarter after its adoption. It restricted non-exempt drugs, and it required pre-authorization and a prospective review before it's prescribed. The prescriptions are that exempt from pre-authorization didn't increase. We saw those stay pretty flat. And the combined effect of those was an overall decrease in the number of prescriptions and a shift towards the mix of drugs dispensed. So there was a cost savings also that happened because of the drug formulary. Next, we're going to look at New York. New York is a little bit more complex. It was adopted the year after California, but they had very different phase-in provisions and timing. New York was adopted in fourth quarter of 2019. So the phase-in that was due to happen in 2020, there were some intentional delays because of COVID and things that were happening there. For lack of a better term, they didn't want to disrupt some of the treatments that were happening for injured workers to shift from formulary to non-formulary or non-formulary to formulary. So we looked at a slightly longer time period for New York to see 1 year after the implementation what was happening. You can also see an effect compared to the non-formulary states there. The other thing you notice in the non-formulary states during the beginning of the pandemic, the first 2 quarters of 2020, there was an increase in the number of, in the average prescription payment. The largest effect of the New York formulary was a decrease in the prescription payments. So this is looking at the number of drugs that had a prescription, and you can see compared to the non-formulary states, New York also had a pretty large decrease between the end of 2019 and the end of the beginning of 2021. This is looking at those measures, the questions that I posed at the beginning of the presentation, and compared to the non-formulary states. And you can see that the largest effect in New York is that first bar there at negative 34%. The prescription payments for medical claims were decreased by 30%, 34%. And that wasn't happening in the non-formulary states. So what kind of drugs require pre-authorization in New York? They do have an approved drug list, so it's drugs that aren't listed on the formulary, and a combination of those that aren't directly listed or compounds. So some of those are pre-made or drugs that are specifically made for an individual. And brand name drugs that have generic equivalents also require pre-authorization, as do brand name drugs that have the same active ingredient but might be at a slightly different strength. So those also require pre-authorization, which is affecting brand name dispensing. The same as California, what percentage of the pre-formulary effective date accounted for the non-formulary drugs? And it was about half. Half of the payments and half of the prescriptions were drugs that were not on the formulary. So it should have a large effect. what kind of drugs were being dispensed in that area. We saw dermatologicals and the lidocaine products. There was also the effect of these higher priced NSAIDs. Fenprofen calcium was something that came into effect in 2019, and you see that in California, that it does show up later outside of the formulary. Opioids, but opioids were also affected by some other provisions, PDMPs, the prescription drug monitoring programs that were being implemented by states over time, as well as other drugs that showed up, new drugs that are being introduced and show up in the workers' compensation system for injured workers. So when we look at the different types of drugs within New York for formulary drugs and non-formulary drugs, this is looking at the number of drugs per claim where there is a prescription. We can see the decrease in the non-formulary drugs by that green line in the middle, but you see a corresponding increase in the formulary drugs without limits, that top bar, the top line there, the dark blue one. And so that's a substitution that physicians are choosing to practice differently and prescribe different types of drugs. Not much of a change in formulary drugs that required limits as well. And what types of drugs were being dispensed or changed with the formulary impact? You can see a large decrease for, again, for the opioids, a little bit for the muscle relaxants and anticonvulsants. There was an increase in dermatologics, and some of those have to do with things that are outside of the formulary that are new formulas. Interesting to note, the anticonvulsants are probably 98% of them are actually not, they're permitted and don't require pre-authorization under the formulary, but New York's drug formulary works in conjunction with other controls that they have in place, including medical treatment guidelines. And the medical treatment guidelines specify that anticonvulsants are used as second step therapy for things like back pain and neck pain. And so one would first have to exhaust first-line therapy drugs before moving to anticonvulsants for pain. So that's why there was a decrease in those. So in summary, the drug formulary in New York was also immediate and sizable, and required the drugs that required pre-authorization were very much reduced. The prescriptions were increased by kind of a substitution effect, a shift in the mix of the types of drug dispensed, and there was a substantial cost savings for prescriptions. And lessons from California and New York, that formularies decreased the prescription drugs that required pre-authorization. There were small increases in drugs that didn't require pre-authorization, and that the payments also decreased for both states. The trends that we see is that there are also new drugs that require pre-authorization. And what the lesson from this is that it's not a static document, that there are continuous reviews required over time, just like any price control, such as a medical fee schedule or any utilization review, that type of thing. So in California, we saw these higher cost NSAIDs in the years following the prescription, or the effective date of the drug formulary. And we also saw in New York some of the dermatologics, the lidocaine drugs, increased after the implementation to be a much larger share than it was previously, requiring, again, review of this. I'm happy to take questions, provide any additional information.
Thank you. Go ahead. Go ahead.
Thank you so much. I'm Liz Ryer from Minnesota. Really appreciate the data on workers' comp, and just have a couple questions on whether you've looked at two things. One, the satisfaction of both patients and providers. From past research I've been involved in, I know that formularies are often linked to frustration and declined satisfaction. And then, more importantly, outcomes. If you've seen any impact, positive or negative, on the patient return to health type of metric. Thank you.
Welcome. We have not done any studies on the patient satisfaction or injured worker satisfaction and pre and post formulary. However, we did look at, as outcomes, one of the things we would look at in workers' compensation is return to work. And was there a delay? Was there a difference? And we don't see any significant difference pre and post formulary.
Thank you. Any other questions? Go ahead, Tammy.
Hi. So looking at your presentation, I have two questions. The first is, from the utilization of the formulary, are you basically just looking at how
Is anybody else?
infrequent they're prescribing these certain types of medications because they have to go through a process now? So is it just a reduction in prescription of these certain classes of drugs?
So we looked at, the data that we look at includes all of the prescriptions that are written on a claim over a period of time. So we looked at the period before the formulary was implemented and then the period after to look at specifically the formulary list and the non-formulary list. Did it change in those types of drugs? So yes, we're looking at before and after for all of those different metrics.
So in essence, you're basically just putting in a pre-authorization, I believe, then, for certain types of drugs, whereas they weren't before, if I'm hearing you correctly.
For some, because we saw a decrease because sometimes there was, rather than have a pre-authorization, there was a shift to use a drug that was on the formulary, which is what we saw in New York.
Okay, and then the last question that I have is, you looked at New York and California, which seem to have pretty significantly higher rates than non-formulary states to begin with. But if I looked at your data as it was coming up, it looked like the institution of a formulary kind of brought them in line with non-formulary states. So I don't know that necessarily if you have a state that's on that non-formulary line with a pretty steady line now and not high utilization, you'd see the same sort of results. Would you agree?
We also studied other states that have recently adopted formularies, Arkansas and Kentucky being two of them, and we did not see as significant effects, mostly because they weren't high to begin with, and they weren't commonly prescribed drugs that ended up not on the formulary list. So it does have a differing effect in different states.
That's what I think. Yeah, I thought. Thank you. All right, thank you.
You're welcome.
Thanks, Tammy. Stephen?
So a two-part question. Within the formularies, did you look to see, or within the prescribing medications, did you look to see how many of the medications were off patent versus on patent? Because I'm just wondering, in the costing structure, I know many of the drugs that are off patent are still only have a singular producer. So I'm wondering if you had any background on the patent versus non-patent. And then there's a follow-up question.
Where we see the effect of the patent falling is usually in the pricing, the payments, because it converts to a generic even though it's no longer covered, but it could still be prescribed. And you could see that effect over time. And when we know that something has either gone off patent or changed classes, we specifically look for those drugs to see what the effect is on the overall prescriptions.
Okay. And secondly, within those studies, have any of the states looked at the opportunity to create a manufacturing formulary or to work in conjunction to actually produce some of those drugs? Because what I'm finding is that the fall off is not as significant. The cost of production, the cost of manufacturing is low, and a lot of the drugs that have come off patent still have a huge margin of profit. And I'm wondering whether there's a way to drive those prices lower by making a formulary that actually works on a manufacturing basis.
I have not heard of that, no.
Okay, thank you.
Thank you, Stephen. Any other questions? I think you did great. Oh, go ahead, sir.
Sorry, so one question around some of the data. I know there are some states that either have or are looking to have medicinal cannabis covered by workers' comp. How has either use of that alternative played into some of the data that you've seen or what you're hearing from some of the states that have formularies?
Also a good question. I think there are 6, maybe 7 states that currently reimburse for medical marijuana under workers' compensation. And the reimbursements would be not directly to a dispensary, they would be reimbursed to the injured worker. And so the data are actually not existent that we've seen in the data so far. We continue to watch that, though. You're welcome.
Thank you. Any other questions? We're good. Thanks, Ramon. Thank you today. If anybody has any questions on the model, check with the staff or myself. And once again, the model will come up for a revote next year. Next person that we have to talk with us today is a presentation on Minnesota's worker comp system. And we have Jennifer Wolf, who's president of the Minnesota Workers' Comp Insurers Association. Welcome.
Thank you very much, Chair. And welcome to Minnesota. I hope you have been enjoying this beautiful weather we have. And I'm just here to make sure that everyone understands that Minnesota does in fact have more lakes than Wisconsin, even though Wisconsin likes to say they do. But welcome to Minnesota, and I'm glad to talk to you a little bit more about Minnesota's workers' compensation system. I represent the Minnesota Workers' Compensation Insurers Association, and we serve as the rate-making organization here in the state. I've been in this role for about 18 months, and I will share that the last 18 months we've really been working with our carriers, our agents, and other members of the stakeholder community to really understand how we can continue to serve and make workers' compensation sustainable here in the state. So let me share a little bit about MWCIA, and then I'll share some measures about Minnesota's work comp system. First of all, our mission at MWCIA is to advance Minnesota's public welfare and our economic security by supporting a sustainable workers' compensation system. And I'll share with you that the concept of our public welfare is really a nod and recognition that workers' compensation does have a societal impact. We're protecting the lives of citizens and ensuring employers bear the cost of coverage, not the state. That phrase, public welfare, is directly taken from our enabling statute, which is to promote the public welfare and to regulate insurance rates so that their premiums are not excessive, inadequate, or unfairly discriminatory. So our core reason for existence is to provide a rate-making report. We publish that rate-making report annually. We've been doing that since we were reorganized in the 1980s, but a rate-making organization in the state has been around since for 101 years. So we're excited to continue that tradition, making sure that we are the rates here in Minnesota are adequate, and also that we provide value and do research and provide insights into Minnesota's workers' compensation system. Just a little bit about what MWCIA does. We develop base rates. Our rate-making report has pure premium base rates that are released on an annual basis. They go into effect in January of every year. We're about to file here in the next couple of weeks our 2024 rate-making report. We also support workplace safety. We promulgate experience rating modification factors, which provide credits and debits to employers based on their individual loss experience. We maintain the workers' compensation manuals for the state. That includes our basic manual, our classification manual, forms, and other manuals, and we ensure that the rules based on those manuals are applied consistently and equitably across the state. We receive workers' compensation policy data, which is used by the Department of Labor and Industries to confirm that employers are complying with coverage requirements in the state of Minnesota. We do a lot of education and outreach to stakeholders about the Minnesota workers' compensation system. We participate with the Department of Economic Development to educate new employers about workers' compensation coverage requirements and making sure they understand the difference in coverage for independent contractors and employees. We do a lot of education with carriers to make sure that they're properly reporting data to the state so that we can have the highest quality of data to inform our rate-making process. And then we use that data to not just create our annual rate-making report, but to do other research which gives us insights into what's happening in Minnesota's workers' compensation system. We've recently collaborated on several research reports with NCCI and the other independent rating bureaus to look at issues related to COVID. We've done 2 studies on COVID, what we saw first in COVID and then what we're seeing in long COVID claims. We've looked at mega claims recently. So that's a little bit about how MWCIA serves Minnesota's work comp community. Now I'll share a little bit about Minnesota's workers' compensation landscape. Minnesota has a very healthy private insurance marketplace. We have over 220 carriers writing coverage in the state. Those carriers serve more than 28,000 employers across Minnesota. And in 2022, we had $1 billion of direct earned premium. And over the last decade, we have seen premium growth of 17%. And in 2022, it mirrors countrywide trends. Premium now is above its pre-COVID levels. And that was really a product of both employer growth and also payroll growth. The assigned risk market has remained remarkably stable for decades. We're at about 3.5% of the private insurance market. We have more than 2 million employees across the state who are covered by private insurance in Minnesota. And in 2022, more than $457 million was paid in direct losses. I want to share just a little bit about my perspective on why Minnesota has created a sustainable insurance market for workers' compensation. In the last decade, Minnesota has seen a cumulative decrease in pure premium base rates of 26%. And there are several trends influencing that decline. First and foremost, we continue to see a loss of frequency, which is really positive news for our employers and workers in the state. We mirror trends across the country that there is a cumulative, although modest, a cumulative year-on-year decline of the number of injuries and illnesses that are impacting workers. Our annual year-over-year decline is about 0.4%, but over a decade, that does add up. Cumulatively, we've seen a decline of low back strains of 23%, and low back injuries have declined by 28% in the last decade. Another contributing factor to the sustainability of Minnesota's market is there has been a real focus, both from a legislative and a regulatory perspective, to proactively manage medical claim costs in workers' compensation. The state has implemented treatment guidelines. They have implemented fee schedules for a variety of different services, and we also have electronic medical billing in workers' compensation. And that has been very effective. In most areas, medical costs are at the median or below average compared to other states, and particularly compared to our regional neighbors. Another, I think, important factor in Minnesota's workers' compensation insurance system is a real commitment to the Workers' Compensation Advisory Council process. So the Department of Labor and Industries facilitates throughout the year a Workers' Compensation Advisory Council. It's made up of representatives of labor and management, and they come together and do a agreed upon bill process. And that has really That agreed upon bill is generally given to the legislature and enacted. And that makes sure that the changes to Minnesota's workers' compensation system represent a balanced perspective. I like to think of workers' compensation as that fragile balance between making sure that the benefit levels are adequate for injured workers, but are at a reasonable cost to employers. And so working together, they propose legislation that both parties can accept. In the 2023, there was a significant bill passed in Minnesota that increased PPD rates for injured workers, and it also provided some adjustments to the dispute resolution process, and we saw some reductions in our hospital fee payment system. But that commitment to making sure there is measured and modest change has really created a very even Minnesota workers' compensation system. And I wanted to share one of the most unique aspects about the Minnesota workers' compensation system is the WCRA. And the WCRA is the Workers' Compensation Reinsurance Association. And Minnesota is the only state that has reinsurance for Minnesota's workers' compensation claims that reach a sort of catastrophic level that is provided by a statutory entity. So our insurers are required to purchase reinsurance through the WCRA. It's the only one in the country that has a statutorily created reinsurance association. And then I just thought I would highlight some current issues that are impacting Minnesota's workers' compensation environment. These issues are not dissimilar to other issues that we see in other state workers' compensation systems. The state is really trying to grapple with how to cover mental health conditions, and in particular, how to address post-traumatic stress disorder. Minnesota has a presumption for PTSD for first responders, and most recently there was consideration of expanding the PTSD presumption to healthcare providers. The legislature enacted a study on PTSD in the healthcare industry, but there has been a lot of consideration and a lot of discussion about how we address mental health, anxiety, depression, and PTSD within the workers' compensation system. We are now, from a rate-making perspective, and looking at what will happen to workplace illnesses as we have seen COVID go from the pandemic to endemic in our communities. So we'll be watching that very closely over the next several years to see how COVID will continue to impact our workplaces. We are looking at extreme climate events. So here we've been experiencing a lovely weather in Minnesota, but our southern neighbors, it's very, very hot. But in the wintertime, Minnesota has seen more extreme winter conditions, and those winter conditions are translating to an increase in slips and falls throughout the winter. And so we're looking at how will more extreme weather events impact our businesses and our workers. And then our mega claims is something that we're looking at. There are many trends that are being driven in the workers' compensation system by a very small percentage of the claims. And so we're seeing an increasing number of claims that have $1 million or more in total cost. And those very significant claims oftentimes are driving the larger claim trends that we're seeing. So these are some of the current issues that we are considering in Minnesota's workers' compensation system. So that's a little bit about Minnesota's workers' compensation system. I appreciate the opportunity to talk with you this morning, and am pleased to answer any questions you might have.
Yeah, I'm from Ohio. We have a monopolistic system, so it's a little bit different yours, obviously. The question I have is, when you contract with providers, is that a standard contract? Do your insurance carriers facilitate that, have their own networks? And if you do your own contracting, what's the structure? Because in Ohio, we're on a Medicare Plus model. I think it's a Medicare, 114% of Medicare. And I'm just curious kind of what you guys are at.
At MWCIA, our members contract, our insurance carrier members, they will develop their own provider contract networks. Here in Minnesota, however, employees actually have the choice of provider, so it's not, the carriers can't direct care. But we do have implemented from a regulatory perspective on pricing. There is a fee schedule. It's based on RBRV. It's an RBRVS-based fee schedule.
Thank you. Any other questions? Yes, sir.
So the PTSD presumption was enacted, I believe, in 2018. And in terms of the rate-making process, so rate-making looks at the previous experience. So we would just be getting in experience related to PTSD. I could not tell you specifically the classification, what has happened at that class code level, but I'm happy to follow up with our actuaries to get more information. If I'll just grab your contact information.
So we're a state-run system in Ohio, and when we talk about PDS, when you look at post-traumatic stress, a person has to have an accident in Ohio to be able to collect. Is that the same way it is in Minnesota?
No. PTSD does not have to be associated with a physical injury to qualify in the state of Minnesota.
Yeah, how can you tell when and how can you cover one area of mental health and not protect all those other areas of mental health with first responders? Don't you worry about lawsuits from first responders who have other mental health areas that they think it came from their job?
It is absolutely a topic of rigorous debate within the Workers' Compensation Advisory Council. At the moment, there is a pretty concrete and firm definition of meeting that PTSD standard. We could get you the legislation on that. And there is, of course, concern about making sure that first responders and all employees their mental health conditions are addressed. But the PTSD, you have to meet specific requirements to be diagnosed with PTSD, and that's how the claims are processed.
Okay, thank you. Go ahead.
Thank you. I appreciate you being here and answering all of these questions for us. Can you back up a little bit and explain who exactly is doing your reinsurance and if there are different carriers for each tier?
So there is only an association, and it was created by statute, and they provide different tiers of reinsurance based on. They provide the reinsurance based on different thresholds, and I could get you some more information. I'm not an expert on WCRA, but I'm happy to connect you to the executive director there.
Oh, that would be great. Thank you.
Thank you very much.
Last on our agenda today is the readoption of model laws. As I said earlier, all model laws must be readopted every 5 years or they automatically sunset. Today we have 4 model laws that need to be readopted. The first one is a Model Act on workers' compensation coverage for volunteer firefighters. The second one is Workers' Compensation Pharmaceutical Reimbursement Rates, Model Act. The third one is Construction Industry Workers' Compensation Coverage, Model Act. And finally, there's a Model Act regarding workers' compensation insurance coverage and PEOs and professional employer organization relationships. So are there any questions or comments before we vote on this? Anybody? Hearing none, I'll entertain a motion to readopt these models.
Mr. Chairman, I so move.
Okay. And I have a second. Have a second over here. All in favor, please say aye. Opposed, nay. It passes. Any other business to be brought before the committee today? Seeing none, we are adjourned. Thanks, everybody, for coming. We stayed on time.
I'm ahead of schedule.
We are.